If you've been mixing business and personal accounts up to this point, the situation is fixable, and that word matters most for coaches who've been mixing for a year or more and feel shame about it. The fix is not quick and it's not free, but it's straightforward. The same entry logic applies to every transaction in every mixing pattern, and there's no judgment call complexity to the work. What makes the cleanup tedious is transaction volume. What makes it necessary is that your books cannot close correctly until it's done, and a CPA cannot file accurate returns from books that haven't been cleaned. The work is fixable because the logic is bounded. Every commingled transaction in a working sole prop or LLC resolves into one of two categories, period. The fix isn't quick because there might be hundreds of transactions to classify across multiple statements and multiple months. The fix isn't free because if the volume is high enough, a bookkeeper experienced in cleanup engagements does the work faster and more accurately than you do it yourself. But the path from mix to clean is methodical, and the end state is identical to the end state of a coach who started clean. That's the part that's worth holding on to. 4 mixing patterns cover almost every commingled transaction I've ever seen in a coach's books. Pattern 1. Business income deposited into your personal checking account, usually because Stripe was set up before the business account existed. Pattern 2. Business expenses paid from your personal card or personal account, usually because the expense came up before the business card was open. Pattern 3. Personal expenses charged to the business card or paid from business checking, usually a small recurring subscription that auto-billed to the wrong card. Pattern 4. Money transferred from business to personal without a bookkeeping entry recording it, usually a casual just move it over without thinking of it as a draw. Pattern 1. Business income that landed in personal gets reclassified as an owner contribution to the business. The deposit was business income regardless of which account it landed in, so the revenue belongs on the business books for the period it was earned. The mechanism for getting it onto the business books retroactively is the owner contribution entry. The business records the income as revenue and records an equivalent owner contribution to the equity account, because functionally you received money on behalf of the business and contributed it. The personal account that received it returns to being irrelevant to the business books once the entry is made. Pattern 2. A business expense paid from a personal card or personal account also reclassifies as an owner contribution. A legitimate business expense was incurred: a software subscription, a conference registration, an office supply order, and the owner paid it with personal funds. The expense itself belongs on the business P&L as a deductible business expense. The mechanism is the same shape as pattern 1. The business records the expense and records an equivalent owner contribution to equity, because the owner functionally injected the cash needed to pay it. Both patterns 1 and 2 are owner contribution flows, where business activity ran through personal accounts. Pattern 3. A personal expense paid from the business card or business account reclassifies as an owner draw. Groceries, Netflix, personal travel, a gift, anything that isn't a legitimate business expense. It doesn't belong on the business P&L. Full of business deductions it isn't entitled to, and your CPA cannot defend it as such in an audit. The mechanism is to remove the transaction from whatever expense category it was misclassified into and record it as an owner draw against the equity account. Functionally, the owner took a distribution in the form of a personal purchase made with business money. Pattern 4. Money transferred from business checking to personal checking with no bookkeeping entry recording the movement, reclassifies as an owner draw, retrospective, dated the same day as the transfer. This is the pattern that produces the most volume for coaches who've been operating informally, because the just move it over move is fast and feels harmless. The transfers add up across months. Each one becomes an owner draw entry dated to the day of the transfer. Debit owner's draw and credit business checking. Exactly the same shape as a properly documented draw would have been if it had been recorded at the time. The universal logic underneath all four patterns is what makes the cleanup bounded and methodical rather than a judgment call quagmire. Every commingled transaction resolves as either owner contribution, business money traveled through personal, or owner draw, personal money taken from the business. There's no third classification for a working sole prop or single member LLC. You're not making judgment calls about what counts as business income versus personal income, or what counts as deductible expense versus personal expense. You're asking one question per transaction, business or personal, and the entry pattern follows automatically from the answer. When the volume of cleanup exceeds what makes sense to do yourself, engage a bookkeeper experienced in cleanup engagements. The rough threshold is more than 12 months of significant mixing, or more than about 500 commingled transactions to process. Below that, the cleanup protocol PDF walks you through the work in a self-directed weekend or two. Above that, a cleanup experienced bookkeeper processes faster, more accurately, and with less burnout than you'd manage on your own. Module 3.2's Bookkeeper Selection Scorecard applies, and for a cleanup engagement specifically, quote a flat catch-up rate that's separate from ongoing monthly bookkeeping, because the scopes are different. Bring four things to the bookkeeper engagement, and the engagement runs cleanly. All bank statements for the period under cleanup, personal accounts and business accounts, every account that touched a business-related transaction during those months, credit card statements for the same period, personal and business, a summary of what you already know, which accounts received business income, which paid business expenses, any transactions you already know were personal that the bookkeeper would otherwise have to flag and ask about, your bookkeeping software login if you have one. Output is corrected books, all commingled entries resolved, a clean P&L and balance sheet for the period, ready to hand to your CPA for whatever amended return conversation that triggers. Pull the statements, count the commingled transactions, decide the path. Under about 100 to 150 business-related commingled transactions, open the cleanup protocol PDF and work through the patterns yourself across a weekend or two. Higher than that, engage a bookkeeper through the Module 3.2 scorecard for a bounded catch-up project with a flat rate. Either way, set a completion date and hold it. Clean books compound forward from the moment the entries are correct, and deferred cleanup compounds backward, getting harder to do as more months pile on top. Once the entries are made and the structure from Unit 6.2 through 6.6 is in place, the discipline holds structurally rather than through willpower alone.